Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. Today we're going to be taking a look at and digging into some of the high interest zones for scalping during the New York Stock Exchange Open. Now I've got the 5-minute S&P chart open with an RTH chart time frame, and we're just going to kind of cover a few of the things that I like looking at when we start the day off. And this is good for like the first 15 minutes or so. Not to say that you can't use this at other times, but really the initial open has so much volatility that as you go later in the day, 10 o'clock, things start dying off a little bit, and you can see a distinct difference in the way that the market moves. So I love the first 15-20 minutes for these types of scalps. And some of the major zones of interest really hinge on how the day starts off, how the first few candles fire off. I'm going to be using the 5-minute chart to give us an idea, but the same concept would hold true if you were looking at a 2-minute chart or a 500 tick or whatever it happens to be as far as your favorite is. So some of the first areas of interest when it comes into scalping the initial few candles that fire off, again, it really hinges on how the day starts off. Well, let's just look at today as an example. We started off with a small upside gap higher, and we kind of kicked things off with a gross looking bull bar, not really proving anything. It's basically a spinning top, equal highs, equal lows, body smack bang in the middle. That doesn't really help us a whole lot. So what would be an area of interest basing it off of this first candle? Well, obviously, there's a huge amount of indecision. The market has no idea what it wants to do, and when you have a first candle that looks like that, chances are there's going to be some kind of failure above or below that. Now, this is a bull bar, and we are gapping up, so my first inclination would be wanting to be a buyer at the low of that candle. Now, it's difficult to see underneath this, but we can definitely tell that even if we are looking at 550, the market did make it all the way up to 7.25 on the next candle. So regardless, we know that it went about 1.5 or 2 points or so from that entry area, and that is a phenomenal zone of scalping interest, given the way that we started off. We have an upside gap to the upside. It's a weak bull bar, all of the wick on the top and bottom. It's a bull bar with bullish context, though, so I would rather buy the lows. Now, from a scalping perspective, buyers will buy here, they'll buy a little bit more, they'll buy a little bit more, and then they'll look to scalp their way back out as it returns back higher. That's one of my favorite areas of interest starting off, is just indecision out of the gates. But as we can see, the market did have a really good move to the downside, and we went into bar 2 with some pretty strong momentum, but ultimately failing at that settlement fill. They filled the gap, and the market rejected back up pretty aggressively, so much so that it closed back inside the first 5-minute bar. So then looking at this bear bar, realistically, if I wanted to be a trader with the assumption that the bulls are still winning, buying underneath this candle for the next bar, remember these are scalps, so the next candle over would need to trigger it in, or even potentially selling not necessarily above this bear bar, but all the way back up at the highs. The bulls who bought the dip are likely going to be taking their profit up towards those highs, and that would be a good area for them to turn back around. Now, as we can see, this candle actually didn't do anything. It didn't trigger anybody because it was an inside candle. The previous candle's high and low, well, that bar never broke out of it. It's all inside of that candle. So what kind of scalping opportunities would that tell us? Well, given the way that the market is moving, I certainly don't want to sell at the bottom at that point in time. Obviously, in hindsight, it would have worked out beautifully. But given the context that we've just built, that would be ridiculous to sell underneath this bear bar. That's a really hard sell to take. Selling directly into settlement, knowing that the bulls are defending this, that's a tough one. Right? So arguably, you won't see me selling underneath that kind of context very frequently, and arguably not even necessarily looking to sell above it. There's too much bullish context. So we're left with the situation of, well, I guess we kind of have to wait. We could opt to be a buyer underneath this low, and you can see if buyers did try to buy underneath that low with the same assumption, if they were buying lower and lower, they were given a chance to get out at a nice little break even on the first entry, profit on the second and third. But, of course, the way that this is bouncing around, again, it's questionable. Maybe the bulls got a little bit stuck at the bottom, right? If we're playing this all sides, technically they never actually got hit to the tick. So it's very likely that if bulls were trying to buy in underneath this low, they got stuck. So even though there isn't necessarily a setup, later on when the market comes back to that zone, that would be a phenomenal zone of interest for a possible scalp back to the downside. Let's see how that wanted to play off. We've got a little more continuation back down. Oops, hang on now. That is their break-even point that they missed. They finally get the test of break-even right here. It immediately rejects back down, and that's the kind of scalping territory that you're talking about. Now, that happened at 12:30, so it's not super valid for what I'm trying to get at here. So let's continue, right? Inside bar tells us a little bit questionable. 100% for me, I really wouldn't be selling underneath that. I know the hindsight shows that it would have worked, but I mean, we've got to be realistic here. That's not the context that I've built. I've built a bullish context from what we're seeing here. And if anything, I'm expecting to see some support coming in, maybe down here or potentially even down here. When the market comes back down into that area, though, that next bear bar closed right in between them, right? Smack right in the middle. Big old bear bar to the downside as well, possibly breaking away from the previous momentum. The support that was supposed to show up, well, it didn't, and if the longs did get suckered in underneath the low of that last bear bar, they were also not given a chance to get out at break even. Scale-in traders obviously had a nice little scalp, but from the strictest of stances, the longs are still possibly stuck there. So going along with that thought process then, aside from the scalp that takes place later on, we could also look at it with the fact that we have a bull bar back to the upside that did not trigger the bulls in, and it goes with another inside bear bar down. This is the first time where we actually have a valid reason to believe that the sellers have a shot to break this lower because of the fact that the bulls are still stuck. They have not been given a chance to get out at break even. Again, in hindsight, it would have been nice to be short from way over here, but really we didn't have a reason to believe the shorts until this inside bear bar demonstrating that the bulls lost their grip. And you can see a lot of sellers pile drove that all the way back to the downside with a heavy drive down. A scalp wasn't even close to a problem, although very attainable. Now, when we've got that giant drive to the downside and a potential twin reversal back up, we have to ask ourselves, is this bouncing off of something logical? Right? Let's look back at the previous day and go all the way down to the lows, and let's see. Well, we've got the volume node, which is down here. They missed it. That's kind of a bummer. Sure, it's a twin reversal, but with this amount of bearishness, do I really want to be a buyer way above it? Again, in hindsight, we can see that it didn't work, but common sense would tell us the same thing. Like, that would be a really dumb place to buy. If we were looking for a twin reversal, then generally speaking, you'd want to see low risk, high reward, low probability. So buyers aren't going to be showing up with any reason above the high of that bull bar. A 3-to-1 for something like that is way above the highs. A 2-to-1 still doesn't fit. The only place a 2-to-1 actually even fits is if we pull back a little bit further. Let's see here. Let's see if they can get it inside the closes. Maybe one more tick up. Yep. So right there is where the longs are going to try coming in because it's favorable from a risk-reward standpoint. Right? Then they can get the risk underneath that last low from a V bottom perspective, but they can also still fit in a 2-to-1. Otherwise, if they're buying up here, they're going to have to deal with the fact that they're going to have to go for a scalp, or they're just going to be sideways and it's just kind of a mess. So we can see very obviously, again, even though hindsight shows us that it did go further, we are demonstrating proof that the buyers are doing what we're expecting them to do. We're on the right trail, right? We're trying to understand what's happening. So we know that the bulls bought here, but they didn't follow through. So if the bulls didn't follow through and we get a bear engulfing candle, well, chances are we're going to see those bulls starting to jump ship and not be too happy if it starts getting underneath their break-evens. Now remember, their break-evens aren't way the heck up here. That's a psychotic entry. We're talking logical break-evens. They close underneath it, immediately pop back up. Now it can't get underneath it. Okay. Oh, now it closed underneath it, and we got a doji. Maybe they can go back up. Oh, they couldn't close there either. Time to get out. Those longs start jumping ship. Now, you would think that if the longs were jumping ship, then they would have a rotation back down through a new low. But they didn't, and they started cycling back to the upside off of that with a continuation back up. So from a scalping perspective then, where would longs be looking to kind of play ball inside of here? Well, obviously this is starting to transition back and forth into a little bit of a different kind of market, but we've got to wait to see who actually takes control. The sellers just tried with this beautiful bear engulfing candle, and arguably the sellers from a scalp perspective did get a scalp taken off. That moved way more than a point, but again, they couldn't make a new low. And if they couldn't make a new low, that means that we know sellers are disappointed. And if sellers are disappointed, they've got a reason to go long back above the last bull bar for a continuation. But again, we're starting to get into that 11 o'clock time frame, so let's go back to the next day. If we're looking at this last bull bar here and go back to the previous day, what do we have? We've got a strong gap to the downside with a very strong bull bar kicking it off. Now, I'm not a huge fan of trading the first candle in and of itself, but when you've got this kind of context in a strong bull bar, scalpers would likely want to buy above that bull bar, or maybe an inside pullback, which is usually what you'll see me do. I like trying to reduce my risk as much as possible, and instead of buying above the highs, let's just say, well, you know what, I'm going to offset this by a couple points, see if I can backfill it a little bit and reduce my risk. Although, when you do that, you run the risk of not getting filled, and when that's the case, when the market returns, you've got one of those opportunities that's a reload shot that they didn't get a chance last time around. But this is one of those unique scenarios where you have three really strong bull bars to the upside, incredibly strong bullishness, and this is one of my absolute favorite type of scalps right out of the gates when you've got a strong open, is buying the first dip underneath the last candle. Especially when you get a whole bunch of wicks like this and context is good. Strong gap down, really strong bull bar, second strong bull bar, third strong bull bar, candle gapping to the upside, demonstrating there's a lot more potential higher. If we're looking at upside candle gap objectives, that would tell us that we should expect the market to reach out towards right about here at 45.8675. So realistically, if we're looking to go along with this, then, well, what better spot than to buy underneath one of these previous candles for a continuation? Now, we never actually had a break of a previous candle until right there. And you'll notice the response was not shy in the least. The bulls ripped that thing all the way back up to attempt the highs. They actually fell a little bit they fell on their face a little bit into settlement. But again, one of my favorite types of continuation patterns when you have a strong open with good context is following along. Now, I know every market is going to show us different context. Every market's going to give us different situations. The important thing here when we're looking for scalps is that we're looking for short-term psychological imbalances where traders are off kilter or all of them kiltered to one side. There's a very obvious long or a very obvious short. They all do the same thing in the same place. As an example, if we go backward over here, this bull bar, in hindsight, looks absolutely incredible. But I guarantee you a lot of traders didn't get that entry when it fired off. So when the market rotates back down to the entry point, remember this is the S&P, so one tick above that candle is the entry point, you're probably going to see a response. Right? This is the kind of thing that we're looking for. They're re-upping into the move. What in the world could stop a move down this strong? Bulls re-upping into a move that they missed. That's called FOMO, and FOMO usually has enough strength to get a scalp off. Those are the types of areas that we're looking for, that psychological imbalance. You're not waiting for a huge reversal, although it may happen, and that's what runners are for, but the idea of these are short-term little imbalances that you can get a scalper's bounce out of. So that's going to do it for this one. I hope you found it useful, interesting, entertaining, and something you can add to your tool belt if you're a big fan of scalping. The open offers a huge amount of volatility, and, well, what better place when you can find a whole bunch of psychological imbalance during all of that volatility. Hard to ask for a lot more than that. That's going to do it. Of course, if you have any questions, drop them in the comments below, or if you have any more detailed questions that you need a heavier answer for, you can shoot them to me via email, jhb@ssftg.com. Until the next one, enjoy, rest up, and we'll see you all then. Thanks.